Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 22nd of March 2022. Trading and investing is not easy and every single person without exception makes mistakes. Let's take a look at some of the mistakes that have shaped the way that I do things. When you're starting out, it's only natural to have high expectations for your purchases. And these expectations come in three subtypes. So the obvious one, of course, is the price targets. So I've got an example of a stock here. And so this person might, let's say, have bought the stock here at $6 because it appears to have broken out from this downtrend. And they might be expecting this to go up to $12. This is on a log scale here. But the question is, how was that target value reached? What are the reasons for aiming for that number? In fact, what are the reasons to suggest that this is going to continue to go up? So the mistakes people make regarding price targets is firstly not having a target, but also secondly, if they do have one, they haven't really put together a case for why that target might be reached. So the second point is volatility. Now, it's very common for volatility to be ignored. It's often just brushed off, yeah. Now, if we look at this stock here, it's obviously very volatile. It's had multiple drops, 50% drops over here, some of these are. And so, of course, that can, of course, happen again. If you bought at $6, what's to say it's not going to drop to $3 and, you know, quick, smart as well, you know. And the mistake here is not expecting or preparing for such an event. So, you know, one of the things that I talk about sometimes is stop losses. Now, if someone's got a stop loss here of, you know, so let's say $5 because they think that's where the breakout line is, let's say, then, and they're expecting the target to be up here, I think that's unrealistic. Of course, if you've got a smaller target over a short-term trading time, then that's a different matter. But if you're looking at a target up here, obviously it's going to take time to get there. And over that time, what's to stop this from dropping 50%, coming straight back up and then making that target? And that does happen. I've seen it happen. So you've got to account for volatility. So the other factor that we want to look at is also expectations regarding time. And so when I'm talking about the time taken to reach the target price. And look, this is something that I'm pretty much always wrong about. And price movements invariably take much, much longer than I expect. Now, other than acknowledging that, I haven't actually worked out a good way of kind of analysing the time component of stocks. I've tried a few various different things, but I haven't found anything that is kind of improves matters for me. Anyway. Now, if you hear yourself saying the words, "it's not going to happen," then you might be making a big mistake. Don't mix up low probability with impossible. Large price crashes can occur, and they can occur very suddenly. Companies can go bankrupt, and even some of the so-called blue chip ones can do that, as we've seen in various examples in the past. And prices could stagnate for years and years. So the other thing to remember is when it comes to paper assets, force majeure clauses can be implemented. And although you may consider the probabilities low for your particular stock or asset, remember that the probability is not zero. How would your portfolio be affected if the unthinkable happened? And so this is a really important thing to consider, and this is where position sizing is absolutely crucial. Being in the market is not the same as sitting in an exam at school. There are no gold stars for being able to memorize stuff. Counterintuitively, the goal is not to be right, it's to profit. And they're not the same things. Yeah, don't mistake being right from making profits or even making big profits. The market is an environment where an understanding of probability and risk is actually the key thing. So if you're not trying to get your head around that, then that's a huge mistake. Another big mistake, I think, is listening to mainstream financial media. Their motivations are to basically get lots of viewers and to sell expensive advertising. And so as a result, they tend to be selective about the views that are expressed in those shows and in fact who's invited to speak on those shows. And basically they've got their own agenda, and I'm pretty sure that your financial well-being is not one of them. I also find that they tend to spew up lots of excessive amounts of jargon. Now, when people do that in any field, whatever field we're talking about, I find that such people are basically trying to say that the subject is far too complicated for you to understand and they're much smarter than you, and so you should take them to be the expert and just do what they say. That's complete rubbish, of course. Now, in my experience, the smartest people that I've come across are usually the ones who can explain a very, very complex topic in a simple manner. Those are the people that I seek to learn from. The media is also great at telling people to buy, but they're not particularly good at the timing. So usually when they're telling you to buy, it's after the stock has already gone up. And of course, don't expect them to tell you to sell when the price has peaked. That brings me to the topic of outsourcing your thinking. Big, big mistake. By this, I mean relying on others to make decisions, to make your own decisions, basically. So the way I see it, you can either delegate full responsibility to someone else. That's acceptable, but then you have to accept that they're completely managing your money and you can't interfere in that. Or you take full responsibility yourself. So like I said, anything in between, I think you're just asking for trouble. So let's say you are relying on someone on YouTube to tell you when to buy or sell. Well, they're not necessarily going to have the same personality as you, the same goals, the same stomach for volatility, or the same risk tolerance that you've got. And so these are mismatches, and that's what can cause problems. Every now and then I get comments from people saying how watching this show has caused them to lose money, or, well, I'll correct them in that and say fiat instead of money. And sadly, those are the people who have outsourced their thinking inappropriately, you know. The aim of this show is not to tell you what to do, it's to discuss various concepts and for you to make up your own mind. If you can't think for yourself, then you've come to the wrong place. This channel isn't for you. Another problem with outsourced thinking is that you're limiting your learning opportunities. So people usually want to go straight to the profits and skip the learning curve. And unfortunately, things don't work like that. The more you can learn yourself, the better. And of course, if you are relying on someone else to make your decisions, that makes you dependent. If that decision maker is not available for whatever reason, you're going to be left high and dry. Next, we have rigid thinking. Big mistake. Now, by rigid thinking, I mean things like having fixed ideas that don't account for new information. So basically, this doesn't work because the markets are dynamic. It's a changing environment. It's constantly changing, and it's been changing over decades. And so our thinking has to be dynamic to keep up with that. One-dimensional analysis, that's another big mistake. So look, when I started out doing all this, I actually just limited myself to just looking at chart patterns. And that wasn't exactly a roaring success. Not because I wasn't good at looking at patterns, but because I wasn't looking at the many other factors in the market. So if you're looking at markets from multiple different angles, then I think that makes a huge difference. And certainly I found it's helped quite a lot. No single tool is perfect, and so it helps if you draw your conclusions based on multiple forms of analysis. And so here I've got an example as a metaphor for that. So you've got this, what appears to be a Rubik's Cube on a table. But if we look at it from different angles, you can see it's not actually a Rubik's Cube. It's flat as a pancake. But yeah, that's a great illusion there. So yeah, look at the markets from multiple angles. It does help. Giving up when you lose. That's a big mistake. I think of losses as lessons, and your goal should be to try and make sure that the losses don't devastate your portfolio and take you out of the game. So basically, you want to have, well, it's better to have multiple small losses because basically you're getting lots of big lessons in return from that. But what you don't want is to have one massive giant loss that takes you out of the game. I've had a couple of viewers who have explained how they had actually lost 90% of their portfolio in their first year, but they actually learned a lot from it and used those lessons to kind of persevere and succeed subsequently. So look, my advice, if you do end up having a big loss, take a break. There's nothing wrong with just kind of leaving things. I actually took quite a long break and actually didn't even think about the markets for quite some time before going back to it, and that gave me a kind of fresh viewpoint. So yeah, take a break, gather your thoughts, and also try and analyze what went wrong. If you can do that, get up, pick yourself up, dust yourself off, and keep pushing forwards. Then, you know, that increases your chance of success in the future. And those people who had commented had actually experienced that. And it's great that they were able to push through those barriers. Practical experience is important. So people often give up before they've actually had the opportunity to build up sufficient experience. And, you know, experience doesn't necessarily always mean putting your money on the line, you know. It can be something as simple as just staring at charts, even just on the, you know, 1 minute or 5 minute scale, because remember that price moves are fractal, and so you can look at a chart and it could represent any time scale. And so if you want to speed up your learning, you know, just sit and stare at very short-term charts live as the price is moving. It can be very useful doing things like that. If you're not building up your experience, then you're kind of relying mainly on luck, I think. And don't stop learning. The world is dynamic and the markets are dynamic, as we've already said, and there's always something new to learn. I'm constantly learning new stuff. And so if you've reached the point where you think you know everything there is to know, then you're missing something. In conclusion, think for yourself, think critically, and think dynamically. If you're not doing these things, then you're at risk of making a big mistake. Next up, the market update. We'll start with gold price in US dollars on the daily scale, and we're still in that cooling off process. As it ended, I still think there might be a little bit more to go. So one of the first things that I pointed out previously was how the volume was increasing quite substantially with this up move, and the good news is that volume is low and decreasing on this down move, which is exactly what we want to see. Are we at the bottom yet? I still think we might come down again a little bit more. I mean, it might just come back to revisit this 1900, but there is still potential for about 1840 to 1860 down here as well. Okay, so just be aware of that. Right now, I don't think we're going to go through this long-term trend line now, because remember, I'm biased to the bull side, and so I think we're going to get a turnaround at some point within this area here. So I'm guessing around this 1840 to 1860 level, because we've got some support over here and over here as well. But yeah, I think this is just a correction before another big move. I think this next move is going to be pretty huge. Okay, and just to revisit what we talked about last week with the Fibonacci levels here. So it is looking like that was a good point to mark our turnaround point there. And so it's hit between the 50 to 61% levels here. It hasn't quite hit that. So yeah, I mean, it might come down and hit that before turning. Or, as I said, the other option is to come down to this 1840 level. So one of those two things, I'm guessing. Not expecting it to go lower than that, really. Okay, silver, similar kind of story. Again, nice to see this quite significant volume rise, which we didn't really see here with this rise. So again, there's something different going on here. And again, a drop in volume with the drop in price. So same pattern as gold. And last week I talked about this 24 level, 24 to 24.50. It actually hit that 24.50 pretty much on the dot there. And so yeah, I'm thinking either there or there before the next move up. And again, the Fibonacci levels for that, we hit the 50% level. Looks like spot on over there, doesn't it? So that was quite nice. But yeah, I'm thinking more the 61.8 level here, which takes us to around the 24 over here before moving up. So a little bit more cooling off, I suspect. And just to have an update on the gold silver ratio. So if we remember, 80, that kind of level is historically quite high. We did have an unusually high level in 2020. That was very unusual, and that was a very good opportunity up there as well. But remember, this is still high. Historically, this is still high. And I don't think we're going to go back up to those levels again. So I think really we're talking sideways or down here. What I've done is drawn this channel here, which we've kind of been trading between for quite some time now. We've just entered the lower half of that channel, and it's struggling to get back above there. So I think as a first step, we're going to go down to here. Now it could kind of muddle around here for a while, and we're kind of looking for a break below this channel here. So low 70s for the gold silver ratio. I think when that happens, silver's going to go absolutely ballistic. It's going to go berserk. So yeah, let's just watch what happens with that. And the gold miners, this is the GDX on the daily scale. And to revisit this Fibonacci, so we hit the 38.2. I still think we're coming down here to 34.5. I think we've got some good support here and here and here. So I don't think it's going to go much below that. And so that would fit in with what I'm thinking with gold. And I think it's going to do that. So yeah, we've still got a bit more patience for the next big leg up here. And actually, no, let's go back to that. So the other thing about this is that we could think about this as being a kind of double bottom. And in that case, this would be the kind of neckline for that. And that would make sense in terms of price coming down to retest that, because obviously we had the breakout over here, quite a strong breakout. It's coming down to retest it before it goes to make its final target, which is potentially much higher than this here. Okay, and silver, this is the SILJ on the daily scale, and I've done a few different things here. So this blue line is the 200-day moving average, and remember we'd been looking at this distance from the 200-day moving average over here. And so the reason I'm bringing this up is just again to show some of the difficulties and flaws of using various technical indicators. And so what we did here, we've got the top over here, the local top here, and that's a local top in that distance from the moving average. And as we were looking prospectively, this looked like a local peak, so we kind of joined that line up. And when we got to here, we kind of got a bit excited because with this candle here, this had broken out. You can see here, it had broken out above that line. And so I thought, oh, that's it. This is the start of the next up move. But actually that turned out to be false. So price just turned around and actually went even lower here. And this again turned back. But then it actually broke through again over here. And so that's marked by this candle here. And so that's actually before the breakout from this longer term trend line here. So this obviously here was a fake breakout. But this seemed to mark that breakout in advance, didn't it? But of course you can't know that prospectively. So you can only do that when you're looking back. So that's the difficulty with looking at this. Anyway, we are above that 200-day moving average. What happened was we broke up through it, came back and retested it perfectly there, bounced up. I think we're going to have another retest. So I think again, maybe looking at going back to about 13 before moving up. So yeah, that's my estimated trajectory there. So yeah, a little bit more patience required, but I think that next leg up in the precious metals and the miners is going to be rather substantial. I think hopefully it will make people happy. That's what I'm thinking. Okay, that's it from me from this week. All the best and see you next week. Bye.